The Money Show.
Personal Finance with Warren Ingram.
Well, Warren Ingram is a certified financial planner at Galileo Capital today, and today is what older people used to call a red letter day. Because Warren Ingram isn't just sort of a voice. He's actually in the studio. Warren, it's nice to meet you and shake your hand. Good evening.
It's so good to be here, and I'm a bit scared now because now you can throw things at me if I'm going wrong.
Well, but my aim is so bad, it's not going to matter. That's all I can tell you. We're talking about interest rates. So there was the interest rate decision last week by the Monetary Policy Committee of the Reserve Bank. They cut by 25 basis points. We heard from the CEO at Nedbank earlier in the show, Jason Quinn, who said he doesn't think there'll be any more cuts this year, in fact, because of the way that things have changed and what the Monetary Policy Committee is doing. And I suppose the first point to make is how important interest rates actually are to anyone trying to build a long-term portfolio.
It's almost one of the fundamental aspects of all of our lives. So it impacts the way we spend, it impacts the way we live, and for a lot of us, debt is a reality, and so interest rates become even more important. You know, the more debt we have, and as we know, our country is super indebted. So anything to do with interest rates has almost a multiplied effect on our lives. So you're right. I mean, I think quite a lot of people kind of get lost in the news of, okay, the Reserve Bank's done this, and actually missing the point that it really, it's bricks and mortar for us. It really has a day-to-day impact.
Okay, so there are lots of different things we can do to try and take advantage of this. When interest rates go down, what's the good news? What does get cheaper? Because it's not good for everybody.
It's not good for everybody. The thing that starts immediately is if I'm sitting with a huge amount of credit card debt or personal loans or overdrafts, if the banks are doing their job correctly, very soon after the Reserve Bank announces a drop in interest rates, it means my debt gets cheaper immediately thereafter. So, a day or a week later, they'll obviously hold out a little bit, the banks, they never want to miss an opportunity, but it means that my credit card repayments get a bit less. And when you're paying your interest at, let's say, 25% a year, any breathing space that you get, a 0.25% doesn't sound like a number, but let's say it's, your credit card, your personal loan, your car, and your mortgage, it becomes hundreds, if not thousands, if not tens of thousands of rands impact in South Africans' back pocket that almost instantaneously.
What gets less attractive? I mean, it's not. There are other things that happen as well. It's not just one thing.
So what happens now is you get the people sitting with cash, especially retirees. Retirees will often store a bit too much money. They won't be listening to their financial planners and who say don't hold cash. And they'll start complaining because they're saying, well, 2 years ago I was, earning 10,000 Rand a month of interest and it was really great. Now, 2 years later, interest rates have been coming down. Now I'm earning 8,000. So cash becomes an unattractive place increasingly as interest rates come down. If all the prognosticators are right and we don't get any more interest rate cuts, it's still reasonably attractive to earn interest now. The interest rates are still quite high, actually, but it is less and less attractive. And remember, you might be getting paid 7% interest. You're giving our friends at SARS 3% of that for tax. So actually, then you're earning 4%. And if your cost of living is going up at 6 or 7, then you're going backwards. So cash is the thing you don't really want to hold in a falling interest rate environment.
Are there particular types of investments that sort of lose their appeal? Are there particular things that actually, is there a particular category maybe that really suddenly don't start to make sense anymore?
Money markets, fixed deposits, even RSA retail savings bonds, which I really like, they will now issue new bonds into the future at a lower rate. So that category, that class of investment will perform worse.
So those would all sort of be conservative investments, right? That kind of thing.
Very cautious, very conservative. And why it's impactful is it's often the antidote to the very aggressive investment. So if you're retired and you need equities because you need to protect against inflation, you hold a lot of cash and that helps you and offsets all the volatility. And now all of a sudden your cash is not so rewarding. You're kind of forced to take a smaller nest egg. So an emergency fund. So it does become a problem, actually.
Are there investments that become suddenly a lot more attractive? Are there some things that actually now really, when interest rates are low or when there's a cut, you actually need to start investigating them a bit more seriously?
So government bonds or corporate bonds, typically you'll find their price, the price of a bond goes up when interest rates go down. and then the other way around. So if interest rates go up, the price goes down. So now all of a sudden you've got an investment which generally pays a rate of interest, a bond, and now you're getting capital growth as well. So that's very nice, and that's impactful for you and me, for example, because we might have it in our RA, or we'll see it in a balanced unit trust. So now we're getting capital growth in those funds as well, and then property companies that trade on the stock exchange, or even normal properties, the property companies, their prices tend to rise a bit when interest rates go down because they all have debt. They'll call it gearing, whatever, but they've borrowed money. They're buying properties, so the less they have to spend on funding interest, the better for them.
I mean, there's a particular property company, a real estate company, that before each monetary policy committee decision the day before sends me a press release with their CEO demanding that interest rates be cut. I mean, it's a pretty self-interested argument, isn't it?
It is, and I think we probably don't have time to get into why the Reserve Bank's doing what they're doing, etc., why interest rates are high. But having said that, that is a self-interest argument, because actually the thing that really wipes us out is the cost of living, is inflation. So whatever we can do to keep inflation down and keep it under control, which actually is interest rates, I think is a good thing. And it's a known factor. So the property companies must deal with it. It's known. It's a known. They can do their jobs despite the interest rate.
It's good to hear your questions tonight for Warren Ingram, the co-founder of Galileo Capital, a certified financial planner. He's actually with us in the studio. 011 883 0702 021 446 0567. I'm sure you have a thought or two about where we are with interest rates right now after that cut last week. Okay, so Warren, interest rates get cut. It's a Friday morning. I sort of wake up and I'm reminded in the EWN news bulletin, oh yes, Lesetja Kganyago made this announcement yesterday. So now they're down. What are some of the things that I should do almost immediately?
Well, one of the things to check is when interest rates come down, if you've got debt, the way that banks will help you is they'll either charge you a little bit less interest, and that means that first new repayment will drop a bit. So if you were paying 5,000 Rand a month on your debt repayment, are they dropping it from 5,000 to 4,900? Do they do that automatically? My sense is if that is the case, and they do drop it automatically, you can actually elect to maintain the original amount. So you then pay actually a little bit more. So if you said to them, don't do that, I'm happy to pay the 5,000. No one likes to pay debt, but I can cope with the 5,000. I'm used to it now. Please don't drop it. If you can live with that, what it means is you're paying your debt down faster. And I think a lot of people don't take advantage of that opportunity. So what they do is they then spend a bit more. They've got a bit more breathing room. They've got a bit more cash in the end of the month. So I think check your debt and try and keep your repayments the same, because you'll get that debt paid much faster. If you can't do that, have a look at the interest that you're paying on all of the debts that you've got, and the one that's costing you the most, at least continue repaying that one. So at least you pay down the most expensive debt, the highest interest rate first. That would be the very first thing I do on the first day that those interest rates are going to come down.
So it's likely that you're paying, say, a higher interest rate on a car, but it is a smaller and of shorter duration debt than your bond.
Yeah.
But if you put more money into your bond more earlier, doesn't that mean over a longer term you'll get more value for that?
You are right, except that for me, the interest rate you're being charged is actually the expensive thing. So,
sure.
So I would rather take a little bit longer to pay off the mortgage at the start. So take a bit of time there, because if you get the car paid off quickly or more quickly, that means you can take the entire car payment, chuck that into the mortgage as well, and then you make a really big impact. So I think there is no investment in the world that grows as fast as your credit card debt, for example.
Yeah.
So actually pay down the credit card debt, then pay down the car, then pay down the mortgage in that order. The trick is not to then go and buy a new car just as you've paid off the old car. That's the thing where we all get caught out.
Indeed, yes. It's 13 minutes now to 8. You with the Money Show. Your questions for Warren Ingram. Okay, what do you do with your investments? Rates suddenly go down. Are there any changes or anything you need to do with actually your investments? How do you sort of approach that? Because you're thinking slightly longer term here.
You are, and I think so. We've spoken about checking your debt and restructure the debt. Next question is, does the mix? I'm not allowed to say the D word anymore because you always rip me off. Diversification. So you've got a diversified portfolio. Is it still correctly diversified? So do you still have the correct allocation to shares, to bonds, to property. Remember, interest rates have gone down, so now the price of bonds has gone up. Does that skew your whole portfolio?
Yeah.
Because if it does, what you might want to do is just check the balance. The other one we didn't really speak about much and is falling interest rates are great for the stock market. So you might find that your bonds have gone up and the stock market part of your portfolio has gone up. So check the balance, make sure it's correct, and then reposition, because interest rates don't change a lot. So to reposition your portfolio because of that is good news. It's a good thing to do.
Is it also a good moment to check your emergency fund? If you're saving just a touch more, maybe you can sort of put some more money into that?
Either top up your emergency fund, or if you've done well and your emergency fund is a bit overfunded now, it's not so rewarding anymore to have extra cash, so maybe you drop it down. So for most of us, it's actually top up the emergency fund. But for some of us, it could be, okay, let me take some out and actually put it into equities or shares or bonds or something like that.
Warren Ingram tonight on Personal Finance, live and in person in the studio, 011 883 0702 021 446 0567. JJ has a question. He's saying, hello, Stephen. I want to know if there is an easy way to work out how much money I need to retire. JJ, I don't even know where Warren's going to start with that. We'll have an answer for you in just a moment.
The Money Show. Personal Finance with Warren Ingram.
Live and in person tonight, the co-founder of Galileo Capital and a certified financial planner in our studio. Warren, JJ's question, I want to know if there is an easy way to work out how much money I need to retire. And I suppose if someone were to say, how much money do you need to retire? All of it.
And some more.
Yes.
I think I want to kind of start with just the psychology lesson quickly, because when people do the number, and I'll answer the question, they might get a little depressed. And maybe the thing to understand is when you do the calculation and you've still got some time to go to retirement, the trick is, can you narrow that gap from 1 year to the next? So if the gap is wide between what you have and what you should have, are you making that gap shrink? And if you are, that's progress. So don't lose hope when I give you the way of calculating. And I think you can do a fairly simple rule of thumb, which is you take all of your expenses in a typical year. Now, if you've got kids and they're at school or varsity, whatever the deal is, remember they're not going to be there. Hopefully, by the time you've retired, you've done that job. So you take your expenses as they are today, and you just take out the expenses that you know will disappear. Then, if you buy a car every 10 years or every 5 years, take 1/5, if it's every 5 years, 1/5 of the car expense, add that to your annual expense. So you get to a number. And let's just say you end up spending 100,000 a year of normal expenses every year. Take that and multiply it by 25. That gives you your retirement number. It's not perfect. It's a rule of thumb, but gee, it is pretty good. I've done that rule of thumb, and then I check it with very sophisticated calculators and modeling tools and stuff that I don't really understand, and the two end up talking a fairly similar story. So that's the answer for JJ. And as I say, year after year, if that gap between what you have and what you need is narrowing, you're doing your job.
Okay, so there is actually a way to go and do it. I mean, in a way that most people can understand.
I think so. And I mean, I think we should all know what we spend. If you don't know, to JJ, if you don't know what you're spending and you want to retire, come on, you've got to do some work, which is at least understand what you spent. And then to be able to multiply that to get to that number is not that difficult. We don't like doing it because it's a bit scary. We don't want to see what the answer is, but we can.
Yeah. Okay. So there's a lot happening around residential property and lower interest rates. And property prices obviously are going to be affected by interest rates, and generally speaking, they go up. Hence my weekly email from the real estate agent.
Yeah, and I think we're actually seeing a bit of anecdotal evidence that the property market in Joburg, for example, is picking up again. You know, it's been a one-way story right now about, you know, just the Western Cape all the time, and Cape Town's pumping. And now we're seeing more and more news about property prices in Joburg picking up. And I think part of the story is around interest rates. So as interest rates come down, mortgages become more affordable. And so that becomes a positive pressure to push prices up. If you were marginal about your rent versus your mortgage, this might just put it in the situation where your mortgage now becomes affordable. The thing about property prices is they don't move like the stock exchange. They don't go instantaneously. So if you were thinking about buying, and you were on the fence, don't sit for too long. You can now use this as an opportunity to get in.
We're speaking to Warren Ingram tonight. A voice note coming through on 072 702 1702.
Evening, Stephen and to Warren. Just a quick one, man. So how much more percentage must you pay on a bond to reduce it from, on a monthly basis, to reduce it from 20 years to 15 years, for instance? So how much more must you put in on top of the normal bond to reduce it by 5 years over that period? I'll listen on the radio. Thank you, Kiki.
Thanks, TK. It's a great question, and I don't know if it's possible to actually work it out. If you've got a 20-year bond and you want to now reduce it to a 15, you want to pay it back in 15 years, how much more as a percentage each month would you need to pay? I suppose it might depend on all sorts of things.
Yeah, those maths problems we were given at school with the story sums, it sounds like one of those, and I was notoriously bad at those, so I don't have a good answer. I think you can probably do a calculation. Just go online. There's lots of these bond calculators, and it'll tell you. So a short answer to say I don't know, but I do think this kind of a drop, a 0.25% drop, is not going to give you 5 years shorter on your bond. So if you continue to maintain your payments, it's going to take 6 or 9 months off, but it's not going to be 5 years.
Yeah. And TK, it's still worth doing, I've got to tell you. I think in the longer run, it is still worth doing. Okay, so when interest rates go down, we start to see more people coming into the market. But do you also need to sort of factor that into your longer term plan? You can't just rush out and buy property now.
No, please don't do that. So you don't buy based on an interest rate cut. Number one, interest rates could go up again. If these tariffs just have a dramatic impact on our country and inflation goes through the roof, it might force the Reserve Bank to push rates up. It's we don't know what we don't know. So you don't buy based on that. The people that would look at this as an opportunity would be people that are renting and are seriously considering buying anyway. And this becomes the tipping point. But equally, maybe that people who are in the property market now, who own a property and were wondering what would push prices up, this is a piece of good news for you, because this is going to push prices up across all sectors right across the country, not just in one area. So it is a very positive trend, but it's not the only one. We've had a few cuts already. So there is a point where it picks up that snowball.
I suppose what people really want to try and do is to make the most out of any cut that they get. And it can actually be quite hard to know where to start. It might also help to know before there's a decision what you're actually planning to do, to have a sort of a strategy.
Yeah. Please have a game plan for your money. And I think if you're sitting with a debt issue, doing that homework to say what costs me the most, that would be step one. Or if you're not in that position and you're looking at property, do the calculation to say, can I afford the property today? Can I cover months and months of bond repayments? What happens if the geyser bursts, and what happens if I need to paint? If you can deal with all of those things, then this might just be the last thing that helps you just get over the line. But we don't make huge moves. We shouldn't because of a 0.25% interest rate cut. It's just another piece of good news.
I think some people feel, and particularly at the moment, that they should take the breather and just have a little bit of fun with it, and I can understand that. Now, obviously I know you shouldn't, but I think also if some people are going to say, okay, well then when can I ever, and that they're going to suggest that, well, actually an interest rate cut, because it's sort of free money, if you know what I mean. This is the only moment that you can do it.
Yeah, I would say I agree with you. We've got to have some fun and life as well. We can't just be totally disciplined. But I would say if you've got credit cards, personal loans, overdrafts, don't use the breather. You've got to get that stuff out of your life as fast as you possibly can. Once it's done, then by all means, use the cut to give yourself a bit of return on life. Have some fun. You can take a bit of time to get the mortgage payments going again. But gee, the credit cards, personal loans, overdrafts, those are the weapons of wealth destruction. You can't give yourself an excuse on those.
Warren Ingram, thanks very much indeed, from Galileo Capital, a co-founder and of course a certified financial planner. Nice to see you here on The Money Show.